Welcome back, everyone. Some months ago, I made a video discussing the sector allocations within my portfolio and some targets and commentary around that. And since it was a while ago at this point and I stated some targets and goals, I figured I would do an update of that type of video. So my sector allocation of my portfolio as is, and commentary around targets and markets that I'm thinking about. So it's just a flashback reminder. Back then, this is kind of some of the charts I showed and how I was thinking. So in the past video, I started by looking at what the portfolio looks like without the uranium. And initially, it kind of looks balanced. However, even without the uranium, it was heavily biased towards a certain type of play. But then with the uranium, all semblance of balance or rational portfolio construction was lost. And my issue was that it became substantially overweight energy and cyclical metals to the point where, in the end, my big concern was that it looked like this, which would be a problem if that whole light green big part of the pie had similar risks, which it may. So what I said at the time was that my internal target from there through the end of 2022 was plus 45% on the portfolio, which is admittedly a lot for a 2-year time frame, and that it would depend mostly on uranium. But I also said, and here was the main point and what kind of leads mostly into today's video, is that I wanted to de-risk. And looking at the last slide, I think it should be obvious why I wanted to de-risk. I was way overweight cyclicals, pro-cyclicals, if you will, so that does not even include gold, which is another relevant weighting. And basically, I wanted to get more defensive. And so here, now, leading into now, I wanted to kind of show how I've done that and the progress that I've made. And this leads to where we are now. And I do want to highlight that many months have passed since the first video where I said all that stuff. And we're talking about a significantly different base in terms of size of the portfolio. So it's not all cut and paste. It's more of it's been a process. So on a very basic level, this is what my portfolio looks like now. So as I approached my target more and more, I was more and more willing to take some risk off and accelerate towards my target. Now, the biggest allocation is now real estate, which involves a number of equities that I've mentioned on this channel, forming the bulk of that. So it's not just real estate, it's real estate developers too. And then followed by uranium being the second biggest allocation and agriculture being a third large allocation, with other bigger ones being gold and utilities. I'll get more towards why I have that in a second, but I'm more comfortable with the risk breakdown of how the portfolio is here, given the market that I'm seeing. Because now, with a bit of a different look at the situation, this wasn't exactly planned like this, but if you can see, the orange on the right represents risk off plus tax. Now I say plus tax because there's a bit of a tax reserve in the real estate utilities section that I may have to tap into in tax season. So I don't want to put that in too much risk in the meantime. So half half risk off, a third still in commodities, and the other remaining bit is a bunch of different bets. But even in the what I call risk off, some of that is gold, which is not exactly risk off. It's risk on, risk off. You know what I'm saying? And so this allocation is more comfortable. It's not going to get as big returns longer term, although I think there's plenty of risk in the portfolio in terms of reward potential. And I also think that, interestingly, a number of the positions I took with the intent of reducing risk have outperformed some of my what would be considered riskier and shooting for higher returns positions. So I don't think there's necessarily a I don't really like saying the term completely risk off because equities have risk, but in terms of sector allocation, the sectors are less historically risky, but I believe that even the sectors that are not designed to be pro-cyclical can have adequate rewards. Now, I think when looking at it like this, we can still understand that I'm very biased towards hard assets and simple thesis or real things, at least, because I'm 1/3 real estate, 1/3 commodities, and 1/3 everything else. And it's really as simple as that in terms of having a portfolio that I'm comfortable with. Now, I do believe in having a top-heavy portfolio, and I believe I still do, which will allow me to outperform if I'm right on my top ideas. And my top 4 positions account for 45% of my portfolio, which is top-heavy, and that's probably higher than what would suit most, but it's how I like it. With the next 5 positions accounting for 20% and the 8 positions after that approximately counting for another 20%. Now, there is some funny accounting in here, so this is just kind of me offhand counting and excluding some positioning tools like options, so it's not necessarily 100% accurate in terms of risk or in terms of whatever, but this is just kind of how I loosely think about it. Top heavy, but diversified as it goes down. So also, as I hinted at along the way, I was fortunate enough to hit my end of 2022 target 1 year, 3.5 months early. So I'm still working on imagining a reasonable next goal and trying to, not too reasonable, because I think pushing for my past goal was very helpful within the context of figuring out what I can perhaps achieve. I'm generally thinking I would like to reduce some risk allocations over the next 9 or so months, ideally in a good way, being that, you know, the price goes up enough to warrant selling, and not price going down would also kind of reduce the allocation, but not be in a good way. But I'm not really in a hurry to sell anything, and I think that, you know, half of what's remaining in that sense is what I hope to be a long-term position, so can't really chop too much unless things go well, and if they do, then I'm, you know, have no idea if I'll completely exit some positions or not, but it's really hard to say at this point. Just my general hope, and again, too early to say that I'm going to do it or not, would be to further reduce that so that I have the capital, hopefully, to recycle the risk into something else and or maybe add back at if prices go lower, which who knows. My other commentary was that I wanted to get 1/3 risk off. Now I am a bit above that target, and as I mentioned, as I got towards my personal target, I wanted to take some more risk off. Now, luckily, in the way that I did it, one of my more substantial risk off positions has outperformed many of my risk on positions. So that was nice. But so the overall pie in terms of risk off is larger than I intended, which just means that I can allocate more towards risk on and keep some more risk on further. So overall, the pie, it's a larger pie now, so it didn't change. As I mentioned, it didn't change. It wasn't as actively managed to effectuate the drastic change as it could have been. So as far as market commentary, I'm going to keep it brief. Things can change very rapidly, but I do view this as a extremely noisy market. And there's some things that I'm seeing that are frankly making me nervous. For example, prices are high, and I know that there's an extent to things I'm allowed to say without people getting upset with me, but Tech Resources executive called this an extremely favorable price environment for commodities. I happen to agree. That's not to say that it can't get more extremely favorable, but again, like, let's say there is inflation. I mean, the margins aren't going to get too much better than they are now. Again, they could stay high for a while, and for sure, we haven't seen the blow up capex, and this is just me ranting on the same thing again. But this is an extremely favorable environment, and it won't last forever. Can things go up another 50, 100% in the meantime? Sure. Can there be margin expansion? Sure. But in terms of fundamentally, how much fundamentally better will things get than they are recently? I can't really say that much for commodities, at least. And, I look at some other things in the markets. I see the yield curve does not look as healthy as it did a few months ago. Gold has perked up. So I no longer view things as all systems go. But there are still things that make extremely compelling cases in terms of the payback time, if prices can just remain here for maybe months. So it's a noisy market. It's more difficult decisions than what's been needed in the past few years to be bullish commodities. And so it's tough, but I don't have all the answers. So on the self-critical side, I keep thinking that although my thought process was that longer term, the safest strategy to make significant amounts of money in the long term was to be essentially a compounder bro. But that's not where the success, the limited success that I've had has come from. And where I have made the bulk of my gains in the market has not come from that type of position, because it has come from positions that are taking more risk, having a relevant but not overly so, finding a mispriced reward relative to the risk. Because the compounder type of thing just doesn't feel right in terms of how it pays for mistakes. Because if your target is high teens or 20s and you make a mistake, the rest of your portfolio doesn't easily pay for that. And so that's kind of the thing that has been in my mind recently. Now, I still think it is probably the right strategy longer term, but I need to find a way where that is not the only strategy, and so I need to target more multi-baggers, and I haven't really been shooting for that recently. I've been working significantly on the risk off side, the stability, but I recognizing that I probably should be looking at more positions that have the multi-bagger potential when I see them and opportunistically. So with that, my thinking going forward is that I want to have multiple elements within my portfolio, one of which being the compounder stocks that will hopefully longer term be assets, more so than stocks. Now, it's hard to judge that in advance, but I think I have a few ideas of what type of thing that can be. Also, I want to have mixed value, so things that kind of get too absurdly cheap to ignore that, you know, could double as a springboard and then earn kind of market returns over time, and just kind of you know, like if you double something and then it has a 10% trajectory, that's almost 20% off of cost, or, you know, just type of value that works in your favor. 3, commodities where applicable. I don't want to be over the top long commodities all the time. It doesn't, it's a cyclical play. If it becomes broadly more than that, and I know I'm thinking as I'm saying this that I have a longer term commodity position that may be destined for trouble. I think that one's different because it has a lower cost on the cost curve and a lot of growth ahead of it, but generally I want to be involved in commodities as a cyclical play. There may be some exceptions, but I think it's probably best for me to try and stick to the cycles. And then 4, I want to try to have some risky bets that might not be cyclical type risky bets. So something that could re-rate into something that, you know, maybe it's a 10 bagger or so, and then is kind of like an average stock, if you will. So, you know, something that could become a multi-bagger and then could kind of keep its value from there. So something that you wouldn't necessarily have to sell after it going up. So a few thoughts on my allocation. Mostly it is kind of where I want it to be. I just made some changes. I'm not generally a risk-loving individual. I'm kind of happy where I'm at. On the margin though, ideally I would recycle some risk at better terms than what we're seeing now. So as some of the risk improves, perhaps move it to other areas and perhaps grow into adding more risk, because from where we are now, I am more than adequately risk off. Now, as the cycle changes, that can change. So just to leave you with a few thoughts, always remember this is just my take, not investment advice in any way. So remember, commodities are priced at the margin, so small changes can mean big changes, and this can happen in both directions. And I'm an individual investor, and I imagine most of you are too, so being able to time cycles in big commodities based on brains and data is not something that I can do. So if I want to survive in cyclicals, with that being a fact, I need to plan accordingly. Similarly, I want to mention that the market essentially has layers and is often moved by more than what it probably ideally should be. There's always something beneath that's moving in either direction, and it may not make sense to either of us. And lastly, I want to remind people that stories are a mess. They're filled with bias and partial truths. I'm not saying that anyone is intentionally deceiving, just that there's never, or very rarely, people talk about the full story in terms of bull case and bear case. You need to recognize that nobody, and I mean nobody, has the answer and certainty around the answer. They may guess right, they may guess wrong, but everything is a guess. And there are always two sides, and then two sides to any story plus price as the balancing factor. For example, the story could be absolutely right and play out very positively as everyone expected it will, and still not be enough. For example, what if Tesla becomes wildly successful in EVs and becomes to the EV market what Toyota is to the internal combustion engine market? Wildly successful. Well, that wouldn't be enough. So the point is, things get priced in, prices matter, but there's also chance of success, chance of failure. And with that, I wish everyone a great day, and until next time, good luck.